Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for Financial Literacy Month, which takes place each April, is Seth Wunder, Chief Investment Officer over at Acorns, to discuss how Fed interest rate strategy impacts the economy and the stock market. Seth, it's great to see you as always. Welcome back to Trade Talks.
Yeah, thanks for having me.
You got it. Investors keep hearing about interest rates and Fed policy. Explain why the Fed lowers or raises interest rates and why we have been in a higher rate environment.
Yeah, so the Fed has two mandates. One is full employment, and the other is price stability, which refers to inflation. And so the Fed either lowers interest rates to promote economic growth by allowing money to be, let's call it, have a lower cost to it. So small businesses and so forth can borrow money so they can grow their businesses, which allows them to hire people and create economic growth that way. Or they raise interest rates in order to pull back on that cost of money or that free capital and restrict growth. So the cost of homes go up. The cost of financing your home goes up. So they use that lever as a way to accelerate or to slow down the economy, knowing that they're targeting whether it be employment or inflation. We've been in this high rate environment for quite a while because we've had persistent inflation. So during COVID, they were worried about jobs and jobs availability. So they flooded a ton of money into the economy to help support businesses. The adverse effect of that multiple years later, we found out, is that it's really caused accelerating inflation. And so we've been in a high rate environment since then. It is important to note, just quickly in this moment in time, you're really seeing the components of inflation decelerate fairly meaningfully, and the Fed has started to soften their narrative or their expectations of forward rate increases. And so that's the economic cycle that we go through between higher rates, lower rates, and on from there.
How long does it take for the Fed strategy shifts to materialize in the economy?
So the old rule of thumb was about 6 months, and you see that a lot in various forms of data. There's some things that the Fed had done starting last summer, starting to talk about increasing rates and accelerating that. And now we're getting to the point where we're seeing inflation components really start to slow. So that's been the basic rule of thumb. But what I would say, though, is it always goes slower and then it goes really fast. And that's a more appropriate way to think about it as well, which is the first moves usually don't have as much of an impact. And then you get to that tipping point where, maybe they do a little too much and then we learn about it very quickly. And so, you could balance those between 6 months, but not a lot in the beginning and very impactful at the end.
Does Fed policy impact the stock market, and what would happen if we fall into a recession?
Yeah, so this is a really interesting one that I think is important to think about it from a skeptical perspective, if you will. So yes, it definitely impacts the stock market, and it certainly impacts economic growth and company earnings and all that kind of stuff. But what the stock market really tries to do is anticipate what the Fed's going to do next. And so a lot of times the media and the way investors get their information is focused on a moment in time or what has happened, as opposed to thinking about what will happen going forward. So, the stock market in 2022 had a very difficult time in the middle and beginning of the year, as it was really focused on the Fed raising rates a lot. Ironically, as the Fed had been raising rates a lot, the market had already found its stability and was starting to look for when the Fed was going to stop raising rates. So it's really an anticipating mechanism that the market tries to do. And so it's important for investors to really think about tomorrow as opposed to yesterday. When you think about a recession, recessions happen. And in fact, this is a stat worth knowing. We've had 15 in the last 100 years. And in almost half of them, 7, the stock market's actually ended higher. And I think, so recession sounds like a scary word. It does impact all of us individually, whether it comes to our jobs and so forth. And so we should be cognizant of what that means for each of us. When you think about the stock market, it's pretty much a coin flip. And by the way, the average recession lasts about 13 months. And so if you're a long-term investor and thinking about things over multiple years, and a recession is a coin flip of up or down, then as a mature long-term investor, you really should be looking past that time period and really thinking about an opportunity to be able to buy low and take advantage of any volatility.
All right, Seth, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.